I have been in practice for more than 45 years, and I retired 15 years ago. I enjoyed every moment of my work as an auditor, but I don't mind confessing that having regard to the challenges which the profession faces today, I don't regret that I retired 15 years ago. I would like to classify these challenges into three broad groups. First, the evolving environment. Second, the regulatory framework. And third, the impact of technology. First, the environment. The recent failures of some high-profile companies have created a feeling of mistrust in the profession, in the media, in the public, and in the regulators. And the auditor has been pictured as the villain of the piece. I think it needs to be considered whether this is a fair assessment. And to do so, we need to understand what the auditor does, what he does not do, and what he is not capable of doing. To do this, we need to go back a little bit into history. I think one of the most important inventions of the last 400 years was the joint stock company. It enabled the resources and the savings of a whole nation to be pooled together and made available to entrepreneurs, to adventurers, to visionaries. And it is to this that we owe much of things which happened, like the Industrial Revolution, international trade, the development of financial markets, and so on. And these in turn have contributed to the creation of goods and services which we enjoy today and take for granted. Now, one of the most important conditions for the joint stock companies to continue to exist was the fact that there was a distinction between the management and the ownership. Now, this distinction between the management and the ownership demanded that the manager should be accountable to the owner and that he should present a statement of his accounting. And you needed someone to verify this accounting and to give confidence to the owner that the accounting was accurate and fair, and thus emerged the auditor. Perhaps the clearest exposition of the role of the auditor was given about 85 years ago by a professor of the University of Amsterdam, Professor Limburg, who published 5 papers under a heading or what he called the theory of inspired confidence. Now, he argued that the auditor derives his function in society from the need for an independent and expert examination of the financial statements and an independent opinion based on such examination. The function is rooted in the confidence that society places on the effectiveness of the opinion of the auditor. The confidence, therefore, is a condition for the existence of the function. And if the confidence is betrayed, then the function too is destroyed. This was as he explained the role. He went on to say that the confidence could be destroyed in 2 circumstances. it could be destroyed if the auditor did not perform what he was capable of performing. And he called this the performance gap. And it could be destroyed if society had an exaggerated idea of what it wanted the auditor to do, and the auditor was not capable of doing it. So he then went on to explain that if society had an exaggerated idea of what the auditor should do, then the auditor would try to meet that exaggerated idea. But obviously it would take time before he could entirely change his methods to meet that idea. And therefore there was a lag, a time lag, which he called the period of uncertainty, and what we now call the expectation gap. When Professor Limburg published his papers, there was a direct link between the owner and the management. But now there is a new host of intermediaries who have been created, like mutual funds, private equity, lenders, etc. And a whole new body of stakeholders have emerged, whether they are customers, whether they are employees, whether they are creditors, and so on. So therefore, we have a much wider body of individuals who have an interest in the success and viability of companies. And when therefore a company fails, the consequences of that failure are felt throughout a much larger function of society, and therefore they create a much greater feeling of distrust. But it's important to remember, therefore, that much of this distrust arises because the public, the society, the regulators are not able to appreciate this difference between the performance gap and the expectation gap. Therefore, it is necessary for us to understand what exactly the auditor does. Now, there are three essential elements in the audit process. The first is the auditor assesses the risk of misstatement of the financial statements. This is an essential part of the audit process, and it needs skill, it needs resources, it needs training, and it needs experience. Now, the assessment of risk necessarily means an examination and testing of internal control system. And it is important to remember in this connection that the primary responsibility for the establishment of the system of internal controls is with the board. In fact, I would like to just draw attention to the requirements of the Companies Act and how that responsibility has been put on the board. The Companies Act requires that the board should give a director's, in the board report, they should give a director's responsibility statement. And this director's responsibility statement has many clauses, but the two important ones are, first, the directors had taken proper and sufficient care for the maintenance of adequate accounting records in accordance with the provisions of the Act for safeguarding the assets of the company, and mark these words, and for preventing and detecting fraud and other irregularities. The Act therefore itself says that the directors have the responsibility for ensuring that the accounting system is adequate for preventing and detecting fraud and other irregularities. And then there is a second clause which says the directors in the case of a listed company had laid down internal financial controls to be followed by the company, and that such financial controls are adequate and were operating effectively. Of course, the Act also placed the responsibility on the auditor, and he has to report whether the company has adequate internal financial controls in place and the operating effectiveness of such controls. Therefore, the responsibility to see that adequate financial controls exist in the company is a shared responsibility. It is there with the board, it's also there with the auditors. And the first element of the audit, therefore, is to ensure that these controls exist and that these controls are adequate to on the basis of this control, the auditor has to assess what is the risk of misstatement. Now, based on this assessment of the risk, you come to the second element, which is that the auditor gathers evidence to see how he can eliminate that risk. And the greater his assessment of the risk, the more vigorous his gathering of the evidence to reduce that risk. So, for both, for assessing the risk and for gathering the evidence, the auditor examines the controls, he interacts with the management, he uses a variety of analytical procedures, and he tests the transactions and balances. And integral to this process is that the auditor has to obtain representations from management. Therefore, if those representations are false or incomplete, that can have a significant impact on the quality of the audit. It is also important to note that the auditor functions within the ambit of the law and also the auditing standards. We must remember that auditing standards are not merely rules of guidance as to how auditors should function. They are also safe harbor rules, which means that they establish that if an auditor has observed these rules, and that is how his conduct should be judged. And it should not be left to outsiders to say, no, the auditor should have acted differently. Because these are rules which are safe harbor rules in accordance with which the auditor acts. And so long as he acts in accordance with those rules, there should be no implication that he's not done his work. Therefore, to summarize, the overall objective of audit, as laid down by the law and the standards, is to obtain reasonable assurance as to whether the financial statements as a whole are free from material misstatement, whether due to fraud or error, and whether, in his opinion, they are prepared in material respects in accordance with an applicable reporting framework. Now, recently, there was a parliamentary inquiry in the UK on the role of auditors, because there also the same issue has happened. Some large companies' failures have taken place. And in this report of the parliamentary committee, they have pointed out that the two most important matters to be noted in this role of auditor are that the key words are material and opinion. And I quote, materiality means that accounts do not have to be 100% true and accurate. and the auditor provides an opinion, not a guarantee or a fact. It is an informed, evidence-based opinion, but it is not expected to be infallible. Now, this is really the balanced conclusion which has been given by the Parliamentary Committee in the US. As we have noticed earlier, an expectation gap exists when there is a difference between what society feels the auditor should do and what the auditor believes he should be doing. And for the purposes of our discussion, let us examine 4 major areas where this difference in perception can exist. The first is the auditor's duty regarding the detection of fraud. It is important to note the following statements made in the auditing standards. First, the primary responsibility for the prevention and detection of fraud rests with those charged with the governance of the entity, that's the board, and the management. Second, the auditor's ability to detect fraud depends on factors such as the skillfulness of the perpetrator, the frequency and extent of manipulation, the degree of collusion involved, the relative size of individual amounts manipulated, and the seniority of those involved. Third, the risk of not detecting a material misstatement resulting from fraud is higher than the risk of not detecting one resulting from error. Fourth, the risk is greater from management fraud because management is frequently in a position to directly or indirectly manipulate accounting records, present fraudulent financial information, or override existing control procedures. And finally, unless the auditor has reason to believe the contrary, the auditor may accept records and documents as genuine. Now, this is what the auditing standards say. My purpose in quoting these provisions is not in any way to discount the concern which the public and the investing persons have in the necessity for the detection of fraud. And I think we should accept the proposition that auditors should accept greater responsibility for the detection of frauds. But as we will see later, technological developments may in the future give the auditor the instruments for better detection of fraud, but today they do not do so. And today, therefore, when we consider the auditor's conduct, we must consider that conduct in the context of the auditing standards as they have been formulated today. A second area of difference is the going concern concept. Now, the going concern concept means that the auditor has to see that the assets which are reflected in the financial statements will realize the values at which they are stated in the ordinary course of business, and the liabilities will be discharged in the ordinary course of business. Therefore, so long as the company continues to operate, the financial statements will be reflecting these values at their correct basis. But if for any reason the company does not function or does not continue to work in the normal course of business, for example, if the company goes into liquidation, then obviously those assets will have to be sold off immediately and will not realize the value at which they are carried. and the liabilities would have to be immediately discharged, and the company may not be in a position to discharge those liabilities. Therefore, auditing standards require auditor to consider whether there is any event, outcome or condition which suggests that the going concern concept may not continue to be valid, and if there is any uncertainty connected therewith, and to report the same. So here again, let us see what the auditing standards say. They say, first, the degree of uncertainty associated with the outcome of an event or condition increases significantly the further into the future an event or condition or the outcome occurs. For that reason, most financial reporting frameworks that require management assessment specify the period for which management is required to take into account all available information. And in India, this period is 1 year. Therefore, both the management and the auditor has to satisfy themselves that at least for a period of 1 year, the company will continue to operate. If they do not go beyond 1 year, because it's not possible to anticipate what can happen. Second, the size and complexity of the entity and the condition of its business and the degree to which it is affected by external factors, and I repeat this, the degree to which it is affected by external factors affect the judgment regarding the outcome of events or conditions. And finally, any judgment of the future is based on information available at the time at which the judgment is made. Subsequent events may result in outcomes that are inconsistent with judgments that were reasonable at the time they were made. Therefore, there are three basic submissions which we should consider. The first is the management and auditor accepts responsibility that the company will continue to operate in the normal course of business for 1 year. They don't accept responsibility beyond 1 year. Second, that decision, the judgment regarding the continuity of the company may be affected adversely if some external event occurs over which the company doesn't have control. And third is, you must, in judging whether that judgment was properly exercised, you must look at the facts which existed when that judgment was made. Not go by hindsight, not say that because a company has failed, therefore the auditor must have made a mistake and he should have pointed out that the company is likely to fail. Now, the recent liquidity crisis we have seen in the NBFC sector, I think provides a good example of how these factors are relevant. Now, as most people have admitted, the crisis in the NBFC sector was created because of the failure of lenders to roll over commercial paper or to continue to provide finance to the company. And there is a school of thought that the source of this crisis really goes back to what happened in demonetization. What happened was that as a result of demonetization, a lot of the money, which was in the form of cash, got converted into bank deposits. And suddenly, therefore, banks had a very large accretion to the deposits which they had. They did not have at that time sufficient opportunities to use those deposits. So they had excess liquidity, And because they had excess liquidity and they didn't want money, they reduced the bank deposit rates. When they reduced the bank deposit rates, there were entities like mutual funds, high net worth individuals, etc., who were accustomed to high deposit rates, who then withdrew the money from the bank and put that money into NBFCs because the NBFCs were offering higher interest rates. And the NBFCs, therefore, with this additional money, considerably expanded their balance sheets, often making investments in illiquid assets. When normalcy returned and banks again increased their interest rates, these depositors wanted to take out the money from the NBFCs and put it back into the banks. And when that happened, the NBFCs were not able to repay their borrowings. However, there's an important thing which you must remember, that there is a difference between liquidity and solvency. The auditor is primarily concerned with solvency. He is not concerned with liquidity. His responsibility as far as liquidity is concerned is restricted to the going concern concept. And his responsibility is restricted to ensuring that the financial statement disclose the correct state of affairs. So the financial statements may disclose that the company has overborrowed. It is no part of the auditor's duty to point out that the company has overborrowed. It is the responsibility of those who read that financial statement to consider how that overborrowing affects them. And if therefore lenders, having seen financial statements which showed excessive borrowing, still continue to lend money to those entities, I don't think one can say that the auditors were responsible. Now there is a third area of difference which we might consider, which is this question of related party transactions. It is true that in many cases of fraud, the genesis is that funds are diverted through related parties. It's also true that loans to related parties are often used as a basis of evergreening. Now we must understand what evergreening is. Evergreening means that if you have lent money to a company or to a borrower, and that borrower has to pay you the interest or repay the capital, and is not able to do so, you give him another loan so that he can repay the interest and the capital. That is a clear case of evergreening. But it can happen that you give that loan not to that party, you give that loan to another party, and that other party pays the first party and the first party repays the loan. Now the question is, the second loan which you gave, was it justified on the basis of the financial strength of that party? I personally believe that is not evergreening. If you give a loan to a second party which has the financial strength of its own and can justify taking the loan, it is no part of your business what it does with that particular money. But that apart, the first question which arises is, how is the auditor supposed to know what the second party did with the money which was loaned to it? And how would he know that that money went to the first party to repay the loan? Now you must remember that there are certain provisions regarding related parties. Both the law and SEBI requirements require that the management must disclose the full list of related parties. SEBI requirements also say that all related party transactions have to be placed before the audit committee, and the audit committee has to see that those are on an arm's length basis. Therefore, insofar as the auditor is concerned, his source of information must be that what is the declaration by the management of the related parties, what are the transactions which have been placed before the audit committee, and he can examine the validity of those transactions because that is the source of his information. But to expect him to find information which is not in that source, to expect him to know that someone has a related party which is not disclosed, or that one party to whom he has given a loan has some other party with which it is related, I think is a bit unfair to that auditor. So the simple point which ultimately comes out is, if the auditor has knowledge about a related party, and that knowledge is reasonably obtained from the records which are available, then obviously the auditor is accountable for whatever has been done with the related party. But if that knowledge is not there in the accounts which he examines, but he is expected to know things which are outside of that knowledge, then I think it's a little unfair to hold him liable. The last area of difference which I'd like to deal with is the question of an auditor's resignation. This has been a subject matter of some controversy. There have been cases where audit firms have resigned. And obviously, when an audit firm resigns, there is an adverse impact on the share market and the prices of those shares drops. Now, this is a difficult decision for an auditor to take. He will take that decision, he may take that decision on the grounds that he has lost confidence in the management, that he is no longer sure that the management is giving him all the information which he needs for the audit, or that he is no longer sure that the information is given is correct or that it is complete. Now, he has two options. He has an option to continue to do the audit and then to decide whether in the absence of that information he is able to give an opinion. And as you know, an auditor can give a clean opinion, he can give a qualified opinion, or he can say, I refuse to give an opinion because I'm unable to judge whether the accounts show a true and fair view. So in the extreme cases where an auditor believes that the absence of information is so vital that I will not be able to give an opinion, he may decide I would rather resign than complete an audit and not give an opinion. On the other hand, there is the counter argument to say that if you resign and the reasons for that resignation are not made public, then there's a lot of speculation and the market might assume things which may not be there. And therefore it would be better if you gave the reasons and then qualified your report and gave the reasons. You could have arguments in both ways. But auditors might feel that I would rather resign and not get involved in a controversy rather than get involved in a controversy, or that I would like to know. It's very difficult to give specific reasons when there is a general lack of confidence. Now, what are the consequences? This is very important. What are the consequences when an auditor discloses in his audit report that there is an uncertainty regarding the going concern concept, or he submits a report, he suspects that there is fraud? Now, we have got to remember that under the Companies Act, there is an obligation cast on the auditor. And this requirement is, it's like this. It says, if the auditor in the course of his duties has reason to believe that an offense involving fraud is being or has been committed against the company by officers or employees of the company, he has to report the matter to the central government. So now, what are the consequences which will happen when he either reports that there is uncertainty regarding the going concern concept, or he reports to the government that there is a suspected fraud? In the first case, this is public knowledge because it's part of his audit opinion. But the question is that as soon as he says that there is some uncertainty regarding a going concern, then straight away there will be problems in the sense that the share price may drop, that the creditors will demand their money back, the banks will stop giving finance. And if you have a marginal case where it's not certain, but it's marginal, that there may be doubt whether the company will continue as a going concern, the very fact of your disclosure will in fact create that situation, and the company will be ceased to be a going concern. So it's a very difficult decision which the auditor has to make. The other situation where he suspects fraud is an even more difficult decision, because what happens is that he suspects the fraud and then he reports the matter to the government. It should remain a confidential communication between the auditor and the government. Obviously, the auditor is not going to disclose the fact that he has made that report, but still that information comes out in the public, and one can only presume therefore that it is leaked out from the government. Now, when that happens, again there are adverse consequences on the company, on its share, but more importantly on its reputation. And we have therefore had a situation now, according to newspaper reports, that where an auditor has reported the matter to the government, the company is now threatening to file a suit against the auditor for a huge amount of damages, saying that it has affected our reputation and we have incurred a loss. So the important point to remember is that there is no provision, there are all these requirements and obligations cast on the auditor, but there is no provision for a statutory immunity to the auditor if he acts in good faith, because ultimately it's an opinion, and obviously the company will disagree with that opinion. So these are some of the differences which I think create the expectation gap, and to some extent therefore create problems for the people to understand what has been the action of the auditor and whether it could have been different. This brings me to the second major challenge which the auditor is facing, which is the regulatory framework. Now, under the Companies Act, there are 4 major agencies with which the auditor would be concerned. The first is the Serious Fraud Investigation Office. Under this provision, the government can refer a matter to the Serious Fraud Investigation Office to make an investigation, and they would make that investigation. Second, there is the National Company Law Tribunal. And there what will happen is that having made that investigation, and government on considering that report may refer the matter to the tribunal. And the tribunal has a wide range of powers which it can exercise. But what concerns us is this power which says that the tribunal can change the auditors of the company. And then, and this is very important, it says that when that order is passed, it can the tribunal can order that individual or the firm shall not audit any other company for a period of 5 years, and it can also track the provisions of section 447, which is connected with fraud, where the minimum, where the offense, the punishment is a minimum imprisonment of 6 months. So visualize this situation, that the government feels that there's something wrong has happened with the company. It asks CIFO to make an investigation. CIFO makes the investigation, and it then says, this has gone wrong with the company, the auditor has failed to do his duties. The matter is referred to the tribunal, and the tribunal then passes an order, as a result of which the company is not allowed to do any audit for a period of 5 years. The firm is not allowed to do any audit for a period of 5 years, and the person concerned may also be imprisoned for 6 months. Of course, there is a right of appeal, and that is the third agency, which is the National Company Law Appellate Tribunal. But what is important to note is that there is a fourth agency, and that is the National Financial Reporting Authority. Now, the ambit of the National Financial Reporting Authority is that it should examine cases of professional misconduct. Now, currently, the institute has a disciplinary jurisdiction. If there is any information or complaint that a chartered accountant has done something for which he should be tried for misconduct, then the institute examines the matter, and after due inquiry, it passes an order holding the person guilty or not guilty. And in certain cases, both can appeal to the government for the punishment and so on. There is still some dispute going on as to whether the matter should be held, the inquiry should be done by this authority or by the institute, and the matter is sub judice. But that apart, the point is that you have a specific authority specified that the disciplinary matter should be examined by that authority. And therefore, if you look at all these four provisions together, I think the regulatory provisions, insofar as the profession is concerned, the audit is concerned, is, to put it in the simplest terms, draconian. There are four reasons why I hold this view. The first is, as pointed out by the UK Parliamentary Committee report, the auditor provides an opinion, not a guarantee or fact, and his opinion is not infallible. So it is possible that he may be misguided in that opinion, but that means it may be an honest opinion. The second is, his conduct must be judged in accordance with the provisions of the Act and the standards. Third, there is a specific authority which will judge his conduct in the light of the Act and the standards, and to see whether he has observed that. And therefore, presumably, that authority, that which makes that judgment, will make a distinction between an error, negligence, gross negligence, willful default, and fraud. And therefore, it is only after such an order is passed and you know what is the nature of the offense that you can levy punishment. If you levy a punishment or threaten to levy punishment without having done all these steps, without having established the default or the extent of the default, and then you say that as a result of that I will debar the firm for a period of 5 years, that I will freeze the accounts of the firm, that I will punish the partners and imprison them, and you do all that, then there is a further consequence which you have to consider, which is that for the alleged defaults of some individuals, you are punishing a whole lot of innocent individuals. Now, I believe from a municipal newspaper reports that some action is proposed against 2 firms. I don't know the details, and I don't want to get involved in the facts of the case. But the simple proposition which arises from the reports is that in these firms there are at least 500 partners. There are at least 4,000 employees. And the total number of people for whom action is proposed is not exceeding 35 persons. Is it proper that the alleged default by 35 persons should adversely affect and so seriously affect 500 other persons and 4,000 employees whose future is at jeopardy on this basis? And I think this is something which I would leave it to you to judge. There's another aspect of it which you can look at. It is true that you have a right of appeal against all this. But in all of these matters, huge costs are involved. Now, it so happens that today there may be 2 big 4 firms which are fighting the matter, and it can afford to pay those costs. Suppose tomorrow this happens with a smaller firm, with a medium-sized firm. Will they have the resources to fight this matter? And I'm reminded in this matter of what happened many years ago in the United States. There was a firm in Chicago called Alexander Grant and Company. It was one of the largest firms in the US, and it went into liquidation because there was a whole series of cases against the firm, because there you have class action and so on. And the managing partner of that firm made a statement, which I still remember. He said, we are going into liquidation not because of the cases which we would have lost, but because of the cases which we would have won. They could not afford to fight matters because they didn't have the resources to fight this matter. This brings me to the third challenge which the auditor is facing, the challenge of evolving technology. Now, I must confess that I am not a technology-oriented individual. In fact, even on simple matters like the iPhone or my laptop, sometimes the assistance of my 11-year-old grandson. And I'm sure there must be a lot of practitioners in this later part of their careers who must be feeling the same. So what is happening, of course, is that the first stage of technological change happened when companies started using accounting systems and ERP systems. And auditors had to change their methods. They were accustomed to dealing with books of accounts, with paper trails, and suddenly they found that they had to deal with paperless accounts and control systems and so on. But things have become much more difficult. We are now in the midst of the 4th industrial revolution. And the 4th industrial revolution means that there are newer and much more informed technologies, advanced technologies. But the growth of a technology is a double-edged weapon. It provides to the profession both opportunities as also risks. On the one hand, because of technology, members of the profession will have direct access to the client's database, and they will have on their self access to new technologies, for example, like artificial intelligence, data analytics, blockchain, and so on. Therefore, as a result, what will happen is that auditors will no longer need to just check samples, but they can check the whole population of transactions. Instead of doing a continuous monitoring of controls, they will do a continuous monitoring on a real-time basis of transactions. They will focus more on anomalies and outliers, and therefore have a much more complex risk assessment. And in short, as someone said, what will happen is that auditors will no longer ask the question, what can go wrong? They will instead ask, what has gone wrong? So this will significantly assist the auditors in the way they do their work. However, there are certain risks. The first risk is that as clients use more and more new technologies, the auditor also will have to use newer technologies which were for obtaining assurance. And as has been pointed out, the auditor will always be shooting at the moving target. And therefore, there may be a gap between the time a new technology is used by the client and the auditor is able to obtain equivalent technology, obtain an understanding. There may be a gap during which the risk increases significantly. Secondly, there will need to be considerable investment in skilled manpower and in technology. So, what is the way forward? I think to decide that or to consider that, we need to go back to Professor Limber. When he said that if the audit function is to survive, it must meet the exaggerated needs of society. And therefore, that is the fundamental point which the future of auditing requires. The auditor has to meet the desires of society. Now, there will be two prerequisites to do this. The first is the auditor will have to give a much greater demonstration of his independence. And secondly, there has to be a significant narrowing of the expectation gap. So, what is the problem regarding independence? One of the most often mentioned factor of independence is the fact that if an auditor does non-audit work, then his independence is affected. Now, the Companies Act has already got provisions which says that the auditor cannot do certain non-audit work, but that is restricted to the company which he is auditing. It does not prevent him from doing non-audit work for other companies in the group. And there is a suggestion that therefore his independence may be affected because he wants that work from the group for other work. So therefore, there are various suggestions as to what can be done. One of the suggestions being that an auditor cannot do non-audit work, that there must be two separate firms, one doing audit work and one doing non-audit work. But this matter again has also been examined in the UK by a different parliamentary committee. And they have said that there are three options. The first is continue the present situation, which they are not in favor of. The second is to have a complete separation, and they point out that if you have a complete separation, then you sacrifice much of the synergies which flow from having a firm which is a multidisciplinary firm, because there is a lot of work where individuals within the organization who are not normally doing audit work would help the audit practice and the other way around. And the third is what they call operational segregation. Now, operational separation means that you have the same firm which has two parts, the audit part and the non-audit part. The two parts do not share in the incomes of each other. Therefore, the auditors don't share in the income of the non-audit part. The people in the non-audit part do not share in the income of this one. However, you still continue to have common services, and if you use each one's services, you charge for them at full rates and ensure that you get that benefit. And I personally believe that if one has to look at this issue at all, then this will be one of the models which can be examined. But it's an issue which is a complex issue and has to be considered. Now, insofar as the narrowing of the expectation gap is concerned, as we have noticed, the new technologies which are available will enable the auditor to take greater responsibility, to report upon the broader health of the company and give greater assurance regarding its future resilience. It will also enable the auditor to enhance fraud risk procedures and give greater assurance in respect of fraud and viability risks. However, to do all of this, they will need specialists in areas such as forensic, artificial intelligence, data analytics, and so on. And they will need to attract the right talent. But given the regulatory framework which we had talked about earlier, I don't think anyone in his right senses, having that skills and that talent, will want to join the audit profession. And therefore, if you want to attract the best talent and you want the auditors to take more responsibilities, it is extremely necessary that the profession and the government review these provisions which are the regulatory provisions. Finally, and most importantly, I think we must appreciate that the desires of the wide body of stakeholders cannot be fulfilled by auditors alone. There are other players in the system of corporate governance who can and who must play their part in that exercise. Thank you very much.